Welcome back to the Denis Damp Show. Today I want to talk about one of the most misunderstood investments in the entire Thrift Savings Plan, the G Fund. Some federal employees love it, others avoid it completely, and many don't fully understand how it works. So let's clear up some of the confusion. The G Fund is unique. It invests in special U.S. Treasury securities created specifically for federal employees. It earns interest daily. It's backed by the U.S. government. And perhaps most importantly, it never loses value because of stock market declines. If you put $100 into the G Fund today, you're not going to wake up tomorrow and find $90 because the market had a bad day. That's why many federal employees feel comfortable keeping money there. And in certain situations, it can be a fantastic tool. One of the best uses for the G Fund is as a retirement cash reserve. If you're approaching retirement or already taking withdrawals, the G Fund can help protect you from being forced to sell stock investments during a market downturn. Think of it as a financial shock absorber. If markets drop, you can draw from your G Fund while giving your stock investments time to recover. That's one of the smartest ways to use it. The G Fund can also provide something many investors value: peace of mind. Not everyone enjoys watching their retirement account move up and down every day. A reasonable allocation to the G Fund can help reduce stress and prevent emotional decisions. Now let's talk about where people get into trouble. The biggest mistake I see isn't having money in the G Fund. It's having too much money in the G Fund. I've met federal employees who kept most of their retirement savings there for decades because they were afraid of losing money. And while their balance stayed stable, inflation quietly reduced their purchasing power. That's the hidden danger. The G Fund protects your principal. It doesn't provide the long-term growth many retirees need. I've also seen people panic when markets fall. They move everything into the G Fund. Then when markets recover, they jump back into stocks. They sell low and buy high, exactly backwards. Fear becomes their investment strategy, and that's usually expensive. So how much should you have in the G Fund? There isn't one perfect answer. Your age matters, your retirement timeline matters, your pension matters, and your comfort level with risk matters. For someone close to retirement, a larger allocation may make sense. For someone decades away from retirement, too much G Fund could limit long-term growth. That's why balance is so important. You need protection, but you also need growth. Because retirement isn't just about avoiding losses. It's about making sure your money lasts for the rest of your life. The bottom line is simple. The G Fund is a great tool, but it's a tool, not a complete retirement strategy. Used correctly, it can help protect your retirement. Used incorrectly, it can quietly hold you back. So take a few minutes this week and review your TSP allocation. Ask yourself one question: is your G Fund allocation helping you reach your goals, or is it there because you haven't looked at it in years? Thanks for joining me today, and I'll see you next time on the